You're watching the program that identifies market trends, provides insightful analysis, and reliable research. Key elements to help you profit from the pros. Profit from the Pros is brought to you by Zacks Investment Research. Learn more by visiting them online at zacks.com. Welcome to Profit from the Pros. I'm Terry Ruffalo. The Dow ended its best January in 14 years on Monday of this week, rising 2.7% for the month. And for an encore, on Tuesday, the Dow closed above the 12,000 level for the first time since mid-2008, and then hit fresh highs in subsequent sessions all during the week. Trading was a bit choppy through the week, but investors, it seemed, chose to spend less time focusing on uncertainty in Egypt for much of the week and more time focusing on the solid earnings season and the better-than-expected U.S. economic data. The closely watched official monthly jobs numbers came out on Friday, showing a much less than expected 36,000 jobs created last month, but the overall unemployment rate fell to 9%, its lowest level since April of 2009, and we'll be talking more about that on the Roundtable segment. But for now, enter Steve Reitmeister, our editor-at-large, to kind of put some stuff in perspective for us. As far as the market's concerned, do you see any reason at all to take money off the table at this point?
Here, it all depends on your time horizon. If you're a medium-term to long-term investor, the general outlook is still very favorable for stocks. You know, we keep talking about that, it's kind of this chain reaction. The economy is improving, corporate earnings are improving, and that's a very favorable environment for stocks. And clearly, after another great earnings season, that is where we're at. So in that regard, I still see the market going higher this year. In the meantime, we have come a long way in a short period of time, and it's possible that we could be seeing a little bit of a pullback sometime soon. But here again, is it a meaningful pullback? If we pull back 2 or 3%, is that even worth trading? So I'd say in general, be in good stocks, and in time during this year, it will continue to advance. So is it time to be like over-the-top optimistic or just cautiously optimistic?
Yeah.
It's not my nature to ever be over-the-top optimistic. So the answer is somewhere in between. I think some of the cautious that we've been talking about in the past, that's starting to ebb away. There's always things out there. In Egypt, it could blow up to something else in the Middle East, and blow up is an interesting phrase for that.
Interesting choice of words.
But in general, here again, we keep seeing these things happen abroad, and we keep seeing them have no effect on the U.S. economy. And so, I think you got to bet on this horse here.
All right, and with us also is equity strategist Bill Wilton. Bill, you follow and you write about small cap stocks quite a bit. So let's turn our attention there for a moment. Share some weekend wisdom with us, if you would, on what sets good stocks apart from bad in the small cap arena.
Well, for just about any stock, it always comes down to earnings and earnings estimate revisions. But particularly with small caps, these are companies that, they're usually earning fewer dollars and cents per share, so they can be a little bit volatile. So what I really try to focus on is the direction of those earnings estimates. So, and not only just year-over-year growth, but whether or not it's improving, as far as what they did the year before. You could have a company showing flat growth from the year before, but as long as those estimates are rising, that's very good for the company. And especially with these small cap stocks, they're at various spots in the business cycle. So, it can be quite volatile. So, like I said, focus on those estimate revisions, the direction they're heading, not the nominal growth rates.
And is that basically the way that investors can mitigate any risk that might exist in these smaller companies, but still collect some decent returns?
Well, not only are their earnings volatile, but small caps by their very nature are a little bit more volatile than other stocks. So one of the things that I always am a proponent for is setting stops and keeping them, whether that's a flat percent loss that you're going to be willing to accept, maybe 10 or 12%, or a dollar and cent loss on those stocks, because a lot of times with these, even the best laid plans can go awry. So it's just, if it's not working, get out of it, move on to the next stock that's going to be making you money. I think that's the best way to mitigate risk with these companies. There's thousands of them out there. There's no need to get overly emotionally attached to any one or two particular companies.
And is it always a good time to be in small caps?
Absolutely. I mean, there's better times than others, obviously, but when it comes to an overall asset allocation portion of your portfolio, there's no reason not to have at least a significant portion of your equity portfolio dedicated to small caps. They outperform in the long run, and they're just, those are the home run growth stories that you're really going to want in your portfolio.
Okay.
Let me just chime in on this.
Sure.
Because the numbers are very clear. Going back 80 some odd years, the small caps have outperformed large caps by 20%. Now, when I say 20%, I mean that's the difference between a 12% annual return and a 10% annual return. The key is each stock individually can be risky, but if you do what he's talking about and look for the ones with the best earnings estimate revisions, and then have a diversified portfolio of those stocks, you get to mitigate that risk and enjoy the upside that small caps provide.
Okay. All right. On your radar for the week ahead?
Yeah, it's going to be pretty quiet. I think people want to see the follow-through on the jobless claims given this Friday's report.
Okay, we're going to follow through with the roundtable. Stay with us. More to come. Here is your Bull and Bear Stock of the Week. An oil company, pretty well-known oil company, as a matter of fact, and an online retailer are this week's Bull and Bear. Shiraz Mian, our research director, here with us again to elaborate on them. Royal Dutch Shell PLC is the oil company. Pretty well-known name, I would think, and probably pretty easy to see why this is a bull.
Exactly. The primary reason is what everybody knows, which is the outlook for oil prices is very favorable, and you could basically pick any of these super majors or just the producers or on the service side. Why Shell versus the others? For the simple reason that Shell has been a laggard or has a reputation for being a laggard for a number of years, particularly a few years back. You would recall that they had this major reserves restatement. Then they had a management reshuffle. Then they had to change the corporate structure. So the Shell's reputation relative to, like, say, Exxon, to Chevron, Total, ConocoPhillips, and I wouldn't even go to BP, has been a little bit battered. And because of that, it trades at a discount to those guys, though its prospects and its leverage to oil prices is as good as theirs. In fact, I would say that they have done an excellent job in turning around their operations. The core of the business is oil reserves and production. And they lagged their peers for a long time based on those metrics, and those things are looking up.
But they're also a big player in natural gas.
They are, worldwide. Shell is not just U.S., not just Europe. They have operations all over the world. Their reports for the fourth quarter was a little bit on the softish side, but the internals and the details of the report look towards the turnaround that I was referring to. So on the whole, a good oil play for the long run for folks who are interested to having an oil exposure.
And PetMed Express is our Bear of the Week. PETS, the ticker symbol. Why?
Just briefly on the overall soft landscape for these retailers, but more than that are a couple of company-specific issues that are weighing on PetMeds. Number one is the competitive landscape. They had the pet medications space pretty much to themselves for a number of years, but with the economy weakening and the consumer relatively more thrifty, some of these big mass merchandiser, the Walmarts and the Targets of the world, are kind of getting into the space and squeezing them. In response to that competitive threat, they are doing a bunch of things which are not holding up. In addition to that, the advertising market has strengthened, which is affecting their ability to promote the brand and new customers. So new sales are down, the average order size is down, their expenses are increasing. When new sales are down and new orders are down, it affects their reorder trends as well. As a result, margins are getting shrunk, and we saw that in each of the last 2 quarters. My sense is that this trend is continuing over the next 4 to 6 quarters, which should keep the stock under pressure, in my view.
Okay, see you at the round table. Another winning stock screen next. Screen of the Week, an overview of a timely strategy aimed at helping you become a more effective stock screener. PEG ratio versus PE. That is what we are screening for this week with Kevin Matris, our top stock screener, who's here with us once again to explain it all. Sounds interesting enough.
Right.
Is this like the Super Bowl of valuations in your mind, or what?
Yeah, you know, I always try to figure out how can I turn my title into a current event. So
Right.
yeah, I figured I'd pick on the Super Bowl.
Okay.
But what's interesting though is this is probably more exciting than the Super Bowl for some.
Says you.
Yeah, but I think the PEG ratio versus the PE is a very cool topic. So let's take a look at the PEG ratio first. Take a look at the definition.
Let's
all right?
do it.
PEG ratio is simply the PE ratio divided by the growth rate. So a value of 1 or less is generally considered good. You're either at par or undervalued. While a value of greater than 1 in general is not as good. So you are undervalued. All right? So here's a couple of examples. And again, it's important to know, too, people like to look at the PEG because they do believe it tells a more complete story.
Okay.
So here's a few examples. A company with a PE ratio of 25 and a growth rate of 20 would have a PEG ratio of 1.25. So it's the PE divided by the growth rate. That gives you your PEG 1.25. Looking at the other example, a company with a PE ratio of 40 and a growth rate of 50 would have a PEG ratio of 0.8. So even though that PE ratio of 40 is higher, that actually has the better PEG ratio.
So is it me, or does this item go beyond the PE ratio?
It really does, because you're introducing that extra component to growth rate. So in general, an investor would look at the company with the lower PE ratio and deem that to be the better bargain. But if you really look at it, you can see that the PE doesn't justify itself because it is trading higher than the growth rate. So if you really want to dig down, you can see that the company with the higher PE ratio is really the better bargain because it's trading at a discount to its growth rate. It is more undervalued, and it should have more room to grow because of that higher growth rate. So if you really want to look at it, the lower the PEG ratio, the better the value, because the investor is paying less for each unit of growth.
And that's the takeaway.
That is the takeaway.
From this piece. All right, well, if there is a screen, in fact, buried in here someplace, now would be time for the parameters.
Yeah, there is. So the screen starts off with looking for companies with a PEG ratio of less than 1. We're using the PE using the F1 estimate. We're dividing it by its F1 projected growth rate. This is a classic textbook setup. Next, we're looking at the average broker rating to be less than or equals to 1.5, so we want to make sure all the brokers are on board. And then we're applying the average broker rating change over the last 4 weeks to be greater than 0. This helps us find companies that have been recently upgraded.
Okay. And stocks that have come through the screen.
Yeah, there was a bunch of stocks. Here's 5 of them. You've got Avnet Inc., Peabody Energy, CSX Corp., Renea Sola, and Toronto Dominion Bank. All of these companies have great-looking PEs, more importantly, great-looking PEG ratios and good growth rates.
Do you own any yet?
I actually have CSX.
Oh,
yeah.
Really? Putting your old money where the mouth
how
is,
did
eh?
that slip in there?
And is this like one of those screens you can do anytime during any market?
Yeah, you know, it's one of those classic values. PE is always good to look at. Price of sales is good to look at. PEG is another one. But you can run this thing anytime, and it's always going to generate a lot of great companies to consider.
Okay. How many times a year do you run it? About?
You know, I got my favorite screens, but I probably run my favorite screens at least a couple of times a week, and this is one of them.
Okay. The Super Bowl of roundtables still ahead. Stay with us. Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Egypt, jobs, and, of course, this week's top stock picks. Now, not necessarily in that order, but that's what we're going to talk about at this edition of the Roundtable with Editor-at-Large Steve Reitmeister, Research Director Shiraz Mian, and market technician Kevin Matris. We're going to start with the jobs numbers that came out. Disappointing news on the jobs front as far as the official government number is concerned. Tell us, for you, how disappointing was it?
Yeah, I mean, I think confusing might be a better word because, you know, this is the, you know, everyone assumed that, okay, there was a disconnect between ADP and the government employment survey last month. That this month it would be corrected, right? That all the discrepancies would be worked out. And for it to lay an egg once again was just befuddling. I, for one, think this is more a statement of the government's survey method being out of step with what is actually going on. There are so many other employment statistics that show the improvements that are taking place. Now, I'm not saying this is a gangbuster, jobs market. Okay, I am simply saying that it's better than what the employment than 34,000, 36,000 jobs grown. Also, I think that the drop in the unemployment rate to 9% is coming down too fast. So that's kind of a funny statistic as well. And that's about more people leaving the job market and saying, I can't find a job. So it's not as good as the 9%. It's not as bad as the 34,000 jobs gained. I think that the ADP is closer to the mark.
But recently we said, at least I thought we said, that ADP had missed the mark in its past history as well, as far as predicting jobs data.
It does. It's looking at two different samples. So ADP is more weighted towards small to medium businesses. The government sample is larger. It's taking a larger universe of employers. But having said all of that, this series, the non-farm payroll series, has missed in 4 of the last 5 months. Right. So we have kind of become used to this disappointment and the series coming short of expectations. It just so happens that December and January seasonally is a very difficult month to handicap for market forecasters as well. I would agree entirely with Steve's assessment of the report that the actual developments in the labor market are different than what this report is trying to tell us. It's probably way better than what this is, and the unemployment rate is probably much higher than what this report is telling us. Yeah.
Well, Kevin, I guess if we're looking for a reason, some rationale, we can always blame the weather.
Right. Well, yeah, I mean, weather did play a factor in it, but I'm going to come to ADP's defense just for a bit. Okay. And I think Steve is right, because if you were to look at ADP outside of the last couple of months, they were very, very accurate in the previous year and a half. Only in the last couple of months did they really have this big disconnect. And I really do believe that ADP is probably closer to the mark than the government. And if you were to look at, internally, you can see that there's good jobs being created in the manufacturing sector, there's good jobs being created in the retail space, same thing with the service space. So it was still anemic, but there's a lot of good things happening in the economy, and I'm not going to put too much credence into this report.
All right, Shiraz, what about Egypt? I think last week you said that Egypt was not a major factor in the impediment to the stock market, our market at least, going forward. Given now we're a week later and other news has come out of that region, do you still have the same opinion?
I feel so good to have been vindicated by the market over the last month. And I still believe that. Egypt, as important geostrategically and politically the country is in the economic realm, and its reference to the global economy and the U.S. market and the U.S. economy, its relevance is quite small. I would put teeny tiny Qatar and Kuwait as far more important to the U.S. economy and the global economy than the heavyweight that Egypt and its president is. They don't produce oil. They are not a huge trading nation. They are not a big weight in the emerging market indices. As long as the turmoil that's in Egypt and spreading to the rest of the Middle East stays within the countries that everybody's talking about, Jordan, Yemen, and stays away from the Persian Gulf, Saudi Arabia, Kuwait, Qatar, and Iraq, I think we are in the clear. As long as we have solid fundamentals on the U.S. side, consumer, corporate investments, earnings, and hopefully at some stage jobs numbers, we should be in good shape.
Steve, you agree?
I mean, we've had some great discussions on Egypt. The fear is that right, it's not Egypt in a standalone basis and what that means for the U.S. economy. It's just that, is this a domino in the area, and does it roll over to some of the other countries that he mentioned? And as you can clearly see, oil prices started to rise because of its potential to spread within the region. So that's really what it's all about. And too often we see that problems in the Middle East don't get resolved with friendly governments getting installed. They get resolved with right-wing nut jobs taking over and like a Taliban,
Right.
and putting everybody under house arrest. So.
All right, I got to move on. Kevin, top stock pick of the week.
Oh, mine is Sunoco, ticker SUN. They are in the oil refining and marketing industry. Of course, they're refining petroleum products and all of this kind of stuff. They also transport their products to their customers. I like them because they have solid double-digit growth rates. The industry looks fantastic. You know me, I like the price to sales, and they have a tiny price to sales of 0.1.
Okay.
So price target-wise, I see them going to $55. That is a 27% increase from here. They look good.
Shiraz.
Denbury Resources. I'm going to stay on the oil channel. This is an oil producers. They have a very strong niche in picking up these old, mature oil fields and then extracting more oil from it as the oil prices get better. Their business model gets more profitable and high margin. I think it's a very good stock.
Quickly, Steve.
Robinson Myers, industrial play, still one of the best sectors, and also playing off of what they're talking about here, Robinson Myers purchased a company that specializes in helping in the oil field services, growing field there, stock worth easily 50 plus.
Okay. Anybody want to make any quick picks on the Super Bowl this weekend?
Oh, is that this weekend?
Yeah, we knew we could count on you.
I'm from Chicago, but I still got to go with Green Bay. I think Aaron Rodgers is the real deal.
All right. Thanks for joining us. Hope the week ahead is a profitable one for you, and we'll see you next time on Profit from the Pros.